This video is brought to you by SoundMoneyCampaign.com. Be part of the solution. Visit SoundMoneyCampaign.com today. Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is Alasdair MacLeod from GoldMoney.com and FinanceAndEconomics.org. Alasdair started his career as a stockbroker in 1970 on the London Stock Exchange and held positions at director level in investment management and worked as a mutual fund manager. He also worked at a bank in Guernsey as an executive director. For most of his 40 years in the finance industry, Alasdair has been demystifying macroeconomic events for his investing clients. The accumulation of this experience has convinced him that unsound monetary policies are the most destructive weapon governments use against the common man. Accordingly, his mission is to educate and inform the public in layman's terms what governments do with money and how to protect themselves from the consequences. Alasdair, it's a pleasure to speak with you today.
It's a pleasure to speak to you, Elijah.
All right, so today I wanted to discuss an article you wrote on your website, financeandeconomics.org. The article was titled, "Timing is Upon Us," and you mentioned in the article, quote, "There is a growing feeling in the corporate sector that the outlook is improving now that money is flowing into the economy, and that interest rates will therefore rise. The message is borrow now to invest in your business while the cost of credit is still cheap." So, do you believe that conventional wisdom is correct and that the economy is improving?
Well, I think we have to define what improvement is. And I draw a distinction between economic progress, which is rarely improvement, and economic growth, because all economic growth is measured by GDP is more money going into the economy. It doesn't tell you how that money is being used. And what we're seeing now is money is beginning to move out of Wall Street into Main Street. It's going into houses, for example. With zero-cost loans, people are going out and buying autos and things like that. So you can see that the money is beginning to shift into the economy, but it is benefiting the few, not everybody. Most people are being screwed on their wages because prices are rising. Admittedly, the statistics don't show prices are rising, but they are rising. And so wages are going down in real terms. Savers are getting absolutely nothing. The only people who are benefiting from this are people who probably don't need to benefit, as it were. But it is their spending that will drive up prices, and that will be reflected in nominal GDP expanding more rapidly than people think. But don't confuse that with economic progress, which this very definitely isn't.
And speaking of this nominal GDP increasing, you also wrote in the article that if the Fed is to keep interest rates at the current level as nominal GDP begins to grow, it has to continue to buy short-term debt to keep the rates low. So the idea that the Fed can gradually withdraw its monetary stimulus is only true if it is prepared to allow rates to rise closer to a market-determined level. So in your opinion, do you see that the Federal Reserve is ready to take these actions? I mean, they just announced Wednesday that they're not going to taper currently, but do you see them tapering in the future? And are they ready to let interest rates rise?
I think it's very difficult for the Fed to actually bring in tapering. I mean, in any meaningful sense, because the economy needs this injection of money. It's rather like a heroin addict. It's got used to it. And unless it keeps on injecting money in the form of tapering and growing banks' excess reserves, then interest rates are going to have to rise. It's as simple as that. And we've had the Fed have told us, and various other central banks, like the Bank of England, the Bank of Japan, and also the ECB, have said we're going to keep interest rates down at close to zero for an extended period of time. And they're talking through 2014, they're talking into 2015. They cannot do that if they withdraw tapering. And I can't see how their interest rate policy. I cannot see how it's compatible with withdrawing the punch bowl. So I just don't see it happening, and it's very, very difficult for markets to adjust to money being withdrawn. I mean, if it would feel like a very deflationary event if they start reducing tapering. With interest rates rising, I mean, do they really want to do that at this stage of the economic cycle? I think the answer is no. So all this talk about, sort of we're going to taper and all the rest of it, it seems to me that it's bluff. And we've had more of that today with Messrs. Bullard and I think Mrs. George from the Fed trying to come in and put a more hawkish spin on it, having seen the market reaction to the no tapering announcement on Wednesday.
Alasdair, I know that you live in the UK. Have you noticed the UK printing as much money just as wildly as the Federal Reserve has been?
Yes. Essentially, I think you have to look at interest rate policy. Different amounts of money in different jurisdictions are required to keep interest rates at these very, very low levels. And from time to time, the Bank of England has to print a bit more or a bit less. But they're all doing exactly the same thing. If anyone wants money, the bank will print it. I think also, if you look at the Japanese situation, I mean, they've now got over 1 quadrillion of government debt that's measured in yen. And for the size of their economy, I mean, this is a truly extraordinary figure. And, now they've decided no longer to pursue so much the financing of government spending by issuing debt. They're just printing it under the guise of trying to encourage economic recovery and to stop deflation. But actually, it's all about the government. The government needs the monies. They can't borrow anymore because their savings are beginning to contract because people are so old. They're drawing down on their savings and so on. So, I mean, Japan has huge problems, but it's a different problem. If you like, it's a different story with exactly the same problem. We've all got hooked on central banks printing money at an accelerating rate, and it's very, very difficult to get off it.
And turning our focus back to the Federal Reserve, you stated in the same article that while the stated objectives of the Fed and other major central banks are to keep interest rates low for an extended period of time, bond yields are already pushing higher, indicating underlying pressures for interest rates to rise. So do you see that the Fed may increase their money printing to keep interest rates suppressed?
Well, at the moment, the Fed is trying to persuade us that they're trying to do the reverse. I suspect you're right. I think they will have to do that if they're going to keep bond yields down at below a market-determined rate. And I think a market-determined rate is probably quite a lot higher than most of us think, because without the central banks in there distorting the market, if the market had to make a rational assessment as to the value of government debt, then I suspect the yields would be considerably higher than the current levels. And I would be talking in excess of 5%, somewhere between 5 and 10% seems to me to be perfectly reasonable for the 30-year bond. But we're nowhere near there. And the only reason we're nowhere near there is because the Fed is intervening. If they're going to stop intervening or reduce their intervening, you can see the scope for the rise in interest rates. And of course, that's going to mess up government finances big time.
Right. And many people believe that we are seeing a bubble being generated in real estate, the stock market, and bonds. But you recently stated that there is only one true bubble, and that it is the major currencies which are being inflated in an alarming and coordinated fashion. So the rising prices of various asset classes are the consequences of these currency bubbles and are not the bubbles in their own right, correct?
Yes, this is a fascinating topic, Elijah, because conventionally, we're all sort of sitting here and we see property prices rising, we see stock prices rising, and we say, oh, they're obviously in a bubble. Now, in the past, that was probably a valid comment. But this time round, money is hyperinflating. And I think this is a very, very important point. What's happening is it's not so much asset prices going up, but asset prices beginning to reflect the fall in the purchasing value of currencies. Now that fall is obviously it's an uneven story. It has yet to affect basic commodities. It has yet to affect manufactured goods. But it starts with asset prices, because that's the way it is. It's coming out of Wall Street, going into Main Street in the form of auto loans and house purchases, and it's institutional money buying houses to let, as I understand it. And that will spread through to the carpenters and the plumbers and the garages and so on and so forth. So all those businesses will benefit, and those people will again pass on the baton when it comes to valuing the currency. They will see, well, we got more money, but do we want the money? No, we want the goods. So in a sense, what we're seeing is the very, very early stages of a flight out of money. It's the bubble, the money bubble is the problem. It's not so much the asset prices.
Speaking of the paper currency losing its value and losing its purchasing power, you recently stated in another article you wrote that, quote, "The path along which monetary inflation undermines a currency's purchasing power was described by Richard Cantillon, who emerged from John Law's Mississippi bubble, the wealthiest commoner in the world. The uneven spread of rising prices following the introduction of extra money and credit is now known as the Cantillon effect. But Cantillon was writing about increased quantities of silver coin. Today we are talking about fiat currency with no intrinsic value whatsoever. Crucially, this means, as well as expecting a fall in the purchasing power of extra money as it chases the same amount of goods, we also have to deal with a paper currency whose value, being wholly dependent on the user's perception, has the potential to collapse completely. So you're saying paper currency's value could just completely go to zero?
Yes. We have been taught when we go and study economics that there is a relationship between the quantity of money and prices, and that's the quantity theory of money. Now, that is broadly true for a situation where, let's say, gold is money or silver is money, and you get an increased quantity of gold or silver coming into an economy. Over time, you find that as that money spreads into wider and wider ownership, that prices start rising. And you get, it starts, as Cantillon described it, from the point where the money goes into the economy and spreads from there. But nowadays, we have a completely different situation, and that is we have paper currencies with no intrinsic value whatsoever. And you can see through the currency exchanges, the foreign exchanges, that these currencies have the potential to move very, very sharply one way or the other, paying no regard whatsoever to the quantity in issue, the quantity theory of money. And I think the classic example of this in very recent times has been Iceland. I think it was around about August 2008, when the crisis really hit Iceland, the currency halved overnight. Now, it's got nothing to do with the quantity theory of money. It's got everything to do with the fact that confidence in the Icelandic krona evaporated at that point. Now, they managed to catch it and stop it going down to zero, but there is the possibility, as they found in Germany in 1923, for a paper currency to go to zero. And the time it takes to do it is probably no more than the function of how long it takes for people to dump it. And nowadays, this can be very, very quick. In Germany in 1923, it took roughly 5 months when people suddenly decided that it was the currency going down rather than prices going up, and they wanted to ditch the currency at all costs. In those days, they would have their money in the bank, they would have to go to the bank, they would have to take the cash out, and they would have to go and spend it in the street. Nowadays, we just do a credit card, electronic, click, and that's it. So this time round, rather than taking 5 months, if we have a complete loss of confidence in the currency, it could happen extremely quickly. And that is the game that is the sort of game of chicken, if you like, that the Fed are playing with when they are debasing the currency the way they are doing. If you look at the way deposits are growing as the best measure of inflation, the dollar is already entered into hyperinflation, as a result, really, of the policies of trying to rescue the banks after the banking crisis in 2008. The quantity of money, dollar deposits it's just gone off the scale. It really has. It's just a huge, great ramp up. And that eventually is going to undermine confidence in the dollar.
I know at the beginning of the year you were saying that you were expecting an economic collapse this year, 2013. Are you still looking for that?
Yeah, well, it's more a currency collapse, and I certainly see it this winter. I think it's quite likely this winter. Everything is moving in that direction. I think in the coming weeks and probably months, we will wake up to the fact that there is no way that either the Fed, the Bank of Japan, Bank of England, or the ECB can stop issuing currency and stop issuing it at an accelerating rate. And the effect of that is that we will wake up to the inflationary consequences, and I think that is going to happen sooner rather than later. We're getting into that end game, and I can't really see how it can be, if you like, delayed very, very much longer.
So are you thinking that we'll wake up one morning and the dollar will have lost a substantial amount of its value, or how do you see this exactly playing out?
Well, it's difficult to say, and I wouldn't want to say that it's going to happen one way or the other. But I think when it happens, I think we will have a crisis, and I think part of that crisis will be an enormous adjustment in the value of paper currencies. How it plays out, I don't know. I suspect that the initial indication of this will be a very sharp rise in gold and silver prices, and also in energy prices. Energy prices might just lag gold and silver. Gold and silver, to my mind, is the real bellwether in this one. So far, they have managed to stop gold and silver rising and reflecting the increased quantity of fiat currency. I was doing the calculation the other day and looking at if you adjust back the price of gold for the increase in the quantity of gold and the increase in the quantity of dollar deposits, adjust the price from January 2000, when it was $283, we are now standing today, as I speak, at about $420. So you can see that the increase in the price of gold is something in the order of 35%. Whereas in nominal terms, of course, as we all know, it went from 283, and currently today it's 1330 or something like that. Very, very different story. What's happening basically is that money is going down. Money is beginning to hyperinflate. And that is the dilemma that the Fed faces when it comes to tapering. You know, they get to the stage where they think, well, we should taper, but no, we can't do it. We can't do it because, well, at least we can say that inflation isn't all that high. Core inflation came out the other day at whatever it was, sort of 1.5%, 2% or something, or less than 2%. But the other problem they've got is that the amount of debt that is around in the private sector and in the government is a record. I mean, there's no other way to describe it. Now, if you raise interest rates deliberately as a result of a tapering policy, then you're going to destabilize the economy. You're going to make a lot of banks get into trouble. You're going to make a lot of businesses get into trouble. Now, the point is that the Federal Open Markets Committee is not there to destabilize the economy. So, they are not culturally set up to do it, and their terms of reference are not to address this. And the idea that we can have, let's say, a Volcker-like figure coming in and, actually gritting his teeth and taking the tough decision, we are well beyond that, Elijah, I'm afraid. And that's what really worries me.
So do you see, governments enforcing price controls during this currency crisis?
Well, I think if you talk to any reasonable advisor to governments, they would say, well, don't be ridiculous putting in price controls. We know why it won't work. We know from economic theory, et cetera, and we know from experience. But when push comes to shove and there's nothing else to do, then yes, they bring in price controls.
All right, and before we let you go, I know we've been over this way too many times, but for our new viewers, what are some ways that people can protect themselves so they won't get too hurt from this currency crisis?
Well, what I do personally, and the reason I work for Gold Money is or do work for Gold Money is that I like to have some gold and silver outside the banking system, stored in a location where I don't live. Now, I know that at some stage, I suspect at some stage, government is going to tap me on the shoulder and say, "Come on, I want your gold and silver." Now, if that's the case, I think I would rather leave the country than break the law. But if I leave the country, then at least my gold and silver is safe in another jurisdiction where my government can't get hold of it. And that would be my primary recommendation. I mean, if you think there's a little chance that what I'm saying is right, then put a little aside. If you think that there is a big chance that what I'm saying is right, put more aside. That is up for the individual to decide. But I think it is imperative that you ensure against a currency and banking systemic collapse. I really hope it won't happen, but I'm finding it increasingly difficult to see how it can be avoided.
So speaking of the confiscation of gold and silver, I know in confiscation of people's wealth, I know Poland just recently confiscated about 50% of retirement accounts. What are your thoughts on the safety of people's retirement accounts in the UK or in the United States?
I must say, I thought that was extremely worrying, that development. The only thing I would say about the UK and the United States is that I think that we've got a slightly better record of respecting people's property rights. Now, having said that, I'm sure that other governments have been looking at this Polish thing. They'll see how it plays out, because it must be very, very tempting to find ways of cancelling government debt. Because they would think that if we can cancel our debt, then we can borrow more. That's got to be the thought process. But the reason that's wrong is you cancel the debt, but you leave the other side of the bank's balance sheets, which are deposits. And with those deposits hyperinflating, you are not actually dealing with the problem. Cancelling debt doesn't actually sort the government's problems out at all. So the Polish thing, I think, was a horrendous precedent. And I just hope that other governments don't pick up on it and decide to try and follow a similar course. But I would not rule it out. When things get to a crisis, anything is possible.
So in your opinion, should people take money out of their retirement accounts just in case the government does try to confiscate them?
I honestly don't know the answer to that. I think different jurisdictions have different rules. One way around this might be, if you can do it, to hold physical gold and silver in your retirement account. But arrange it if you can, so that you hold it through someone like Gold Money in a foreign jurisdiction. Now, admittedly, it's not going to stop government maybe grabbing your retirement account, but I think it would make it a bit more difficult for them to retrieve it, or it could do. But that is a very difficult one. I mean, the trouble with all these things, all these schemes like retirement accounts and so on and so forth, is they are set up with the blessing of the Revenue Service and government, and guess what? They've got control over it ultimately, and that's the problem.
Alisdair MacLeod, thank you so much for joining us today. People can find you at goldmoney.com and your own website, financeandeconomics.org. Are there any last thoughts you'd like to leave with our viewers?
Well, all I can say is I hope I haven't ruined your coming weeks, but I think these are dangerous times. Just watch out and see how this tapering story plays. And I think people will begin to realize increasingly that actually the Federal Reserve Board has very little alternative but to continue with quantitative easing to infinity.
Alisdair, thank you so much for your time today.
That's my pleasure.
Go to financeandliberty.com and subscribe for free for more interviews and financial insight.